Previously on Dry Powder,
we definitely want to open up private markets as an asset class to a broader audience.
Thomas Eskebaek, CEO of Titanbay, described how he partners with wealth providers and gives them access to the top-performing private equity funds. But Titanbay is not the only business in town. In recent years, we've seen a proliferation of digital platforms for private assets. And there is an explosion really going on now of private asset class opportunities that folks really want access to. Now, what a lot of people are calling the democratization of private assets is not going to be without challenges. Today on Dry Powder, Thomas and I will discuss whether private investing platforms could enable private equity houses to finally make inroads into retail capital or small individual capital, which has eluded the industry for decades. I'm Hugh MacArthur, head of Bain's Global Private Equity Practice, and this is Dry Powder. Now, Thomas, you've talked a bit about small institutions, you've talked about family offices, you've talked about high net worth individuals. What we're really discussing here, I think, at its heart is the movement toward retail for private markets and the private equity industry, which has been a goal for many, many years. Almost half of the world's investable capital is with quote unquote retail or more individual family office style investors.
Yeah.
Is this type of digital platform that you've created a real movement into retail private equity, or is it a step before that? How would you describe where we are in the journey toward true retail access and what that's going to look like for private markets?
It's a very interesting question, and I actually think there are quite big regional differences. So we are headquartered in London, and my priority focus right now is covering all of Europe. We do have investors from the Americas as well. We have investors from Asia Pacific. We have investors from the Middle East as well. And right now, our belief is that it's held by the regulators, as probably it should be, i.e. the regulators are setting the limit for who can make investments into this asset class. What we are trying to do is to help enable a broader group of investors invest in the asset class, but in a thoughtful and considered way. And the reason for that is very, very simple. The regulators are there to protect, in particular, the retail investors, and they are progressing cautiously in this space. What we want to do, and we are actually engaging the regulators both at a European level and beyond, is to show them that this can be done in a way that is still protecting of the investors and thoughtful for the investors. Fundamentally, we believe that there is a trend towards private markets, that private markets and private equity in particular is a very interesting asset class for these types of investors. And if you do it thoughtfully, the returns and the potential outweigh the risk that you can see.
Yes, I can certainly see why, from a GP perspective, you'd be very interested in these types of investors because the pools of capital in aggregate are quite large. But talk a little bit more about the forces that are making these quote unquote retail investors, if I can just use that blanket term to call them that, interested in the private markets. What are the forces that are kind of nudging them towards saying, hey, take a look at some of these funds, some of these asset classes that you might not be as knowledgeable about because they're interesting for your overall portfolio? Well, why? Why would that be?
I cannot claim to be a macroeconomic expert, but I think some of the trends that we have been seeing over the last few years, there have been an increasing trend towards private markets and for smaller and smaller investors who want to get into private markets. I've read some data recently that the number of listed companies in the US, for example, had gone from 5,500 to 4,000 over the last 15 years. You see companies staying private much longer, and you see a lot of the growth happening in the companies that are private. And that means that as an investor, in particular as a smaller investor, if you do not have exposure to private markets, you're missing out on a large part of the growth opportunities that are out there. So I think that's the overall shift that's driving the focus on private markets.
Yeah, it's an interesting macro stew when you think about it. Your point about even some of the largest economies like the United States having more thinly traded public equity opportunities is reflected in many different economies around the world. And as we know, for well over a decade, the credit markets have been very challenged from a yield perspective for investors. And so to some extent, this question is being asked, where do I go to actually get real access deeply into different opportunities, investment styles, industries, subsectors? That's not as easy a question to answer as it was perhaps 15 or 20 years ago for a smart investor who has the ability to put money to work and just looking for ideas really to put money to work.
And I think a big part of it is also showing the regulators that this can be done in a responsible way, in a way that is in line with the investor's interest and not just about selling stuff, but actually giving the investors real opportunities for real returns.
See, to me, that's a really critical issue, Thomas. I mean, the two things that come up when you talk about private market access for individuals are number one, liquidity, because typically you don't have a lot of liquidity in private markets. And number two, or you can order them any which way you want to order them. Number two, the regulatory issue about how do we make sure that this is all sort of as it would be with the public markets or close enough that we can all trust the system. And as you look, we've seen a number of these private investment platforms, many of them digital, crop up in recent years. How do you see that space evolving? How do you see the kind of, what are we going to be looking at as a landscape of places where people can go to invest over the next, say, 5 or so years? Regulation issues, liquidity issues. What's that look like in your mind?
I think from a regulatory perspective, I think we are already beginning to see the regulators recognizing that the industry has matured enough that there are real opportunities for investments in this space. They are recognizing that if done well and if done responsibly, then this asset class should be something that the smaller investors have access to, because right now, by restricting their access or keeping them out of that, you're actually harming those investors by not opening up that asset class to them. That said, the responsibility of the regulators, and in particular, I would say the responsibility of us as an industry, is to make sure that this is done in a way that reflects the investor's interest. And that's what I think will win out as we look forward, say, 5 years. It is those approaches that have the investor's interest at heart and bring that to the front. That's how we see it develop.
Yeah.
The other part of the question was about liquidity.
It's really around liquidity. You know, if I'm an insurance company, if I'm a pension fund, I obviously have very sophisticated cash flow modeling. Yes. I don't expect to have liquidity for this part of my portfolio. If I'm an individual, I may have other issues and actually need liquidity or figure out I have to have. How do I think about that in this type of digital platform format?
Yeah. And I think that's one of the problems that need to be solved. And I think there are different approaches to that. Sort of at a very high, sort of almost philosophical level, private equity and private markets is almost by definition an illiquid asset class. And there are different attempts to make it liquid, but you lose a lot of the benefits of the asset class by trying to add a liquidity component to it. So there are different attempts at that, and some work better than others, but at its heart, it is an illiquid asset class, and I'm not really expecting that to change. So the way we see it and the way we look at it is that we recognize that our investors will occasionally have the need for liquidity. But at the same time, most liquidity solutions are not necessarily in the best interests of the investors, because there are multiple levels of discounts applied generally in a secondary situation. Not always, but as a rule of thumb. Therefore, our view on it is that our investors need to have the opportunity should they need it, but we should not encourage our investors to think of this as a liquid asset class. They need to be aware that it is illiquid, and that has pros and cons, and they should be planning for that. So the way we do it is that we give our investors the tools to understand, what does the cash flow profile look like? What does that look like over time? When you make an investment, what should you be expecting in terms of cash flows over time? In addition to that, should the need arise, we do have a secondary liquidity capability, both to other investors through an auction-like setup, but also through some large partners who are liquidity providers in that secondary market. So I think we've solved it largely for the majority of cases. And it's very important, from our perspective at least, that our investors understand that this is inherently not a liquid asset class, and they should not treat it as such. They should not come in and expect to be day trading. They should come in with the expectation of holding these assets for a longer period of time.
Got it.
And as long as you go in with that, and you then provide the opportunity for liquidity should the need arise, then I think that solves the problem.
Got it. So think in terms of years, not in terms of days when investing.
Absolutely. Absolutely.
Now, one of the challenges for smaller investors to actually take advantage of some of these private asset opportunities that are out there, which can be, as you well know, in the millions and millions of dollars. To what extent do private investment platforms or digital platforms like Titanbay, or what's the ability to actually drive down that minimum for private equity investment?
I think that's one of the core components of the offering, in the sense that, as you say, a lot of the leading funds have minimum investment sizes of, say, 20, 25 million, and you simply won't get through the door unless you can put that amount of money to work in one single check. And very few of our investors are able to do that. So the way we work is that we have feeder funds where we collate or combine a number of smaller investment tickets into one ticket towards the underlying GP. So from the GP's perspective, they see us as a single institutional LP. We operate like any other institutional investor would. So they don't see any of that complexity. And then behind us, we handle all of the complexity of letting individual investors in. So our minimum ticket sizes are currently about 125,000 euros or $150,000. And that allows a much broader segment of investors to invest in this asset class. One of them is actually quite interesting. We have an altruistic foundation based out of Finland, and they've been looking to get into private markets for several years, but they can't because they can't allocate enough money. And given the investment minimums we talked about previously of, say, 20 million per fund, you need 10, 15 funds, you end up with quite large numbers, and they can't meet that. But they do understand the asset class, and they do understand the need for having diversification and the benefits of the asset class. So when we engaged with them, we actually had that conversation quite early on, and we're discussing the idea of building a portfolio over a 3-year period, because again, you also need diversification across vintages. So what we've been doing with them over the last almost 2 years now is building up that portfolio across different strategies, different geographies, different sectors and industries, different currencies, and now also different vintages, so that they have that diversified portfolio. And that's a very exciting process because it's a prime example of the types of investors who really understand and benefit from this asset class, but also understand the complexities and the need to have that diversification. And we're very excited to see them now grow into the point where they're beginning to see sort of early signs of funds coming back out again, and then building towards that stable portfolio that they're looking to build.
So you help them think through their cash flow planning, the J-curve management, any secondary positions they need to take to help ameliorate that and build the diversified portfolio of 10 or 15 positions to make sure that they are well suited to withstand, different rigors and different challenges that might present themselves by subsector or by economy or by currency or any of the different risk factors that they may take into account, and put them through to the other side where they're actually starting to see cash come back out as well as capital calls come in.
Exactly. And that's very exciting, especially because the foundation is actually supportive of the arts, which is quite interesting. So helping them making these types of investment, make these types of enhanced returns is something that's a net benefit out there in the real world as well.
I think private equity fueled humanities is a wonderful place to be.
Agreed.
Well, Thomas, I want to thank you very much for stopping by the show today. It's been incredibly educational to learn how smaller investors are getting access to some of the most sophisticated and intriguing investment opportunities on the planet. So thank you for the education, and thank you very much for the comradeship this morning.
Thank you so much, Hugh. I really appreciate the opportunity to share our story.
I'm Hugh MacArthur. Thank you for listening.